Silver and gold both had positive weeks in fiat US dollar spot price action, up about a percentage point or two respectively since the close of last week. The silver spot price finished the week around $15.25 per troy ounce, while the gold spot price finished the week around 1,415 fiat Federal Reserve notes per troy ounce. The gold-silver ratio still hovering around 30-year highs, closing the week near 93 ounces of derivative silver to acquire 1 ounce of derivative spot price gold. This week, we're going to welcome a new guest to the Silver and Gold podcast. You're going to hear why this longtime gold trader believes the yellow precious monetary metal has been trading stronger than silver of late, and how long he thinks this trend may continue along for. As well, what are some of the catalysts that might change this trend? And what about the gold-silver ratio? How much longer and how much higher might this go? A longtime commodity trader, Mr. Lanci of Echobay Partners, he will be speaking with us following this short message from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. We are committed to being your trusted source for low cost, highest quality investment grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets Wrap. This week we welcome a new guest to the Precious Metals Podcast. He's a longtime commodity trader specializing in gold and silver derivatives throughout his career. Mr. Vince Lanci of Echobay Partners. Thanks for coming on our podcast.
Thanks for having me.
Vince, just for myself and our listeners, if you wouldn't mind to take us back a little bit and give us a bit of your experience in commodity trading.
Sure. I think the origin for me learning about commodities was an offshoot of me being an options trader. I received, after working at Lehman Brothers on the sales side, I took a position with a small options market making firm called Cooper, Neff and Associates. And we were very statistical and we were options market makers. And part of that is, you're trading options off of X. And silver was the first place that I had heavy exposure to when I was promoted to trader, both as a futures trader and as an options trader, observing futures behavior. So that's my baseline of learning not only how to trade options, but before that, understanding the market structure and the behavior of futures. And silver was the tutor that, had everything in there without being gentle. You learn lessons quickly or you didn't learn them. So silver is where I started. And then after that, I've traded everything there is in New York, options and futures. But silver is the beginning.
Mm-hmm. So silver is where you had your, basically got your teeth cut. But it seems right now that you're currently focused on trading in the gold derivative market. But you did start in the silver market, and you say it's your first love. Specifically, why are you fond of silver? Like, what are the underlying reasons, perhaps?
Well, aside from it being, the first thing that I cut my teeth on, which I think everyone holds the first place they've been in any business as a special spot in their heart, because your mind is open and you're learning so much. The education continued. Once we'll put this in quotes, once I mastered silver options, I then got slapped in the face by silver futures. And then after I understood the silver futures market structure, I got slapped in the face by Philip Brothers and then Warren Buffett. And what the silver market continued to educate me on was not just things like technical analysis, but it was the word isn't cartel-like, but it would trade in chunks, and there was a certain transparency to it that although I didn't know why X was buying, I knew he was buying. And you could see and learn the whole market structure. And from what I learned in silver, I've applied it in every market, and it has been correct. In one sentence, market structure, silver taught me market structure. I've taken delivery. I've learned what happens when you take delivery. I've been run in by SilverDoctors in '94. I was on the right side of the '97 trade, and that was all market structure based. And who's the buyer, who's the seller, and what are the rules in place that favor interaction? You know, is this market biased to be short or market biased to be long? And silver and gold at the time were markets where the structure of the market itself gave you better odds to be short. Mm-hmm. And that's where we are.
Mm-hmm. Now, lately, lately the silver spot price, just bringing it to today, there's a lot of people who've been, excited about the strength that gold's been showing of late, popping above 1,400 and staying there pretty well. It seems though that the silver spot price is not performing as great versus the gold spot price. And is it just simply that when a potential bull market begins, gold leads typically at the beginning of a bull market? Is that simply what we're seeing right now, or are there other reasons why perhaps silver may be lagging a bit?
I think that people believe that gold leads bull markets, and I'm not going to say that I completely disagree with it because we're just talking about opinions here. But I believe there are two types of markets where the metals rally. The precious metals market rallies, and then the other is one or the other metal rallies for different reasons. And by that, I don't believe this is a precious metals bull market. Mm-hmm. I believe this is a gold, I'll put bull in quotes, bull market. Silver is being left behind because the relationship between silver and gold has fundamentally and at a regulatory level been ripped apart as of March 2019. So I think that, to quote a friend of mine in the industry, silver has become a modified gold trade, meaning people are more comfortable being short silver than they are gold now for multiple reasons. Mm-hmm.
So I'm sure we're going to get into this because right now the gold-silver ratio's nearing 30-year highs, and it's hovering around 93 or so.
Right.
Now, you mentioned March 2019. What's the specific importance of that month and obviously that month this year?
Yeah, well, there has been for years. Let's stay on point. The EU has issues, okay, and part of the issues are banking laws and regulations, and they have not been as strict as they would like them to be. And Basel III, there's Basel I, Basel II, the conferences that come out of Basel are about banking rules and regulations, how much money you have to have on your balance sheet. It's about solvency. And after Brexit, Basel III, which had been discussed for some time, had been drawn up, was implemented was put off, but it was implemented March 29th, 2019. And that rule change, which we can get into if you want, completely changed let's call that a catalyst. It becomes a catalyst for what gold bulls and someday silver bulls, gold bulls have been waiting for. Mm-hmm. Gold is now actually money. It went from a tier 3 asset to a tier 1 asset, which is an important concept if you want to get into that. It'll take a sentence.
Mm-hmm. Yeah, no, a tier 1 asset, right, is like the least risky asset you can hold, which is typically, the best sovereign debt instruments like U.S. bonds, for instance, or now gold specifically. I'm guessing that's essentially what tier 1 means, correct?
Absolutely. To maybe put an ironic smile on people's faces that are listening, when the Bretton Woods Agreement was, when U.S. withdrew from it, they withdrew from the gold standard. And part of that is changing the rules so that gold would no longer be considered money. And they took gold, which was a tier 1 asset, and changed it to a tier 3 asset. And what that means is when you are a bank and you go to the Fed window to borrow overnight, they'll give you X amount of dollars based on how much money you have on your balance sheet, how much cash, how much tier 1 liquid assets you have. And so, as you said, bonds, money, those are cash. Gold was not cash, those were considered money. Mm-hmm. And gold was tier 1. They demoted it to tier 3. What does that do? If you take an asset and it's a tier 3 asset, it is at the level of, and I kid you not, art. A tier 3 asset is when a bank goes to the window at the Fed and says, I need to borrow money, and then the Fed says, let me see your balance sheet, and it says you've got, let's say, $1 billion on your balance sheet in cash. They'll say, well, your cash level's too low or your balance sheet is not right. And so what a bank would do is it would sell gold. It would sell gold because if gold were trading $1,500 an ounce, they were only given $750, 50% of its value, as liquid cash. So you took a haircut on it. And so that's why everyone's, buy gold when the stock market dumps. No. If you're a bank and you're long stocks, you sell gold so you can get that extra $750 to cover your margin and go to the Fed window. And that's what changed. In Europe, it went from tier 3 back to tier 1, which means there are less natural sellers of gold now. Mm-hmm. And that's been a major, major difference as part of the banking overhaul in Europe.
So that's helpful. That example that you just gave probably gives people a better understanding as to what happened in fall 2008, for instance. It made no sense. There was a bit of cognitive dissonance where you had, the stock market tanking and people really scared and people very, very concerned about the banks that they held cash in even. And you had the gold spot price precipitously dropping at the same time, same with silver, et cetera. So potentially that's a lot of what occurred maybe for a short time frame.
Yeah, absolutely. And that was the knee-jerk reaction, impulsively, to liquidate everything that's not nailed down. Sell your grand piano so you can buy food, so to speak. But it did augur in a nice bull market between then and 2012.
So swinging it back to this gold-silver ratio, nearing its 30-year highs, hovering around 93. Both of you and I probably would agree that we probably will see 100 at some point. But how much higher and longer might this go before we begin to see a reversion toward the longer-term averages and medians between gold and silver?
Well, I don't know that my answer is going to be popular, but it's going to be frank. I think before I answer, we should very quickly look at platinum and palladium. Mm-hmm. Platinum, and again, you can look this up to verify if I'm right. Listeners can look this up. But, having spoken with auto executives, the price spread between platinum and palladium to switch over from palladium to platinum, even in gasoline engines, which is where palladium is referred, is about $400 to justify switchover. And yet they haven't switched over, and it's almost 2 times the price. Why haven't they done that? So because of, all I'm saying is I'm giving you an example of where fundamentals are not a high priority in platinum and palladium, which, taking that, the market can stay irrational a lot longer than we can, as the saying goes. So bringing that back to silver gold, I'd like to say, and this is unpopular, but I believe it's true, that we are right now watching silver and gold, their relationship be shredded as a tracking product for each other. Mm-hmm. In a precious metals bull market, let's say because the dollar goes to zero in terms of its buying power, you're going to see both of them go up as they should. In any other type of environment, you're now going to see, for some time, you're going to see gold actually behave like silver in the sense that it's more volatile. You're going to see silver behave like it's gold because it's less volatile. And that is because since Basel III, you have 3 central banks that are buying now: China, Swiss and ECB, and Russia too, and they're starting to trip over each other buying it, and that attracts the hot money, and that makes gold a little bit of a more volatile market. And as a byproduct, people are selling silver against gold because silver is, quote, not money. Now, they're right, and there's probably a lot of money to be made doing that. So where could the spread go? The old high, I think, was 101 on record. It could go a lot higher, but I'm actually using the spread, and I am trading the spread, but I don't trade based on directional opinion. I trade based on break momentum. I think the spread. I think this is important to note. The margin requirements for a long or short in either silver or gold futures is between $3,000 and $4,000, let's say. The margin requirement for a spread, long gold and short silver, is 25% of the margin of an outright. So I believe, if I believe that the relationship for now is tearing apart, that margin requirement is too low. And if I'm a hedge fund and I want to deploy less capital, use more leverage, and believe in this whole Basel III, gold is money, silver is not, what am I going to do? I'm going to buy gold, I'm going to sell silver and say I'm precious metals flat. I've only tied up 25% of my firm's capital, and you've got this irrational trade that's going to keep going on, not unlike palladium and platinum. I hope that answers your question.
Yeah, I mean, it does. It's, I guess, a couple things come to mind. I mean, when I look at silver and gold and their relationship, obviously the question is how long can this go for? And if you're someone who's a bullion bull for silver, then maybe it's good value. The same goes for platinum. I mean, platinum is cheaper versus gold than it's been in like 120 years. And if you know, yeah, I mean, the amount of platinum above ground is just, it's so much smaller than the amount of gold bullion. So it's really a question of, well, is this really good value? I mean, are these historic generational lows for the value of silver, platinum versus gold, are they going to continue for how much longer, et cetera? So it's really something to noodle over.
I think you bring up a very interesting point because talking about platinum palladium now is like talking about gold and silver in the 90s in this respect. In the 90s, silver was but became a lot more silver came on the market from acid heap leaching. So you'd mine for nickel or you'd mine for copper, and then you take all the junk and throw all the waste in a pile, throw some acid on it, and you would pull out silver. So silver was, to be derogatory, a waste product of other mining, which brings us to where we are with platinum and palladium. There's not a lot of platinum above ground, but platinum is a, quote, waste product of ridiculous. When platinum and palladium occur next to each other in nature, which is kind of scary to my point. Forget platinum palladium switchover, right? Forget that concept. What happens if the price of palladium crashes? Now, platinum could go up because I'm sure people have this platinum palladium spread on. But what happens to the price of platinum if palladium crashes and those miners that are making money off of palladium stop mining altogether? Does platinum explode? I don't. It should. I don't know. But the point is the platinum palladium. When you get to the fundamental aspect of the mining, silver and gold in the 90s was like platinum palladium now. But I don't think I've answered your question at all. I think there are several ways, and this is all empirical. I'll change my mind as evidence comes in. But there are three things that can make silver strong, regardless of gold. If you want, I can.
Yeah, well, let's go through that because I'd like to talk about some catalysts potentially for silver coming ahead.
Sure. Okay, the first one is based on a history lesson, and it's not that long ago. If you go back to 2016, July, the May through July Brexit thing, I was writing at the time for fun and profit, and trading a personal account. But I was shocked that I think the gold-silver ratio was stable, if not coming in. That meaning silver overperformed gold. And, during the Brexit vote surprise, the flight to safety was, Brits and other people in Europe putting their money in gold. Why did silver go to, $21 and change? Why did that happen? And I think, I know that there was a short. I know that some shorts got killed. I know they were. I knew some banks got hurt. Let's put it that way. But it was completely unexpected. And I think I expected the gold-silver ratio. People buy gold, not silver, in the sense of what's more money. But I think what happened then is a lesson going forward, and that is there were too many shorts in silver, and there was a surprise catalyst. Now, I may be wrong about this. It's worth looking up. But since 2016, since that spike, silver has been told to sit down. And one of the ways silver has been told to sit down is by, I believe that the COMEX vault of silver may have actually started adding since then. I'm not sure. It has to be looked up.
No, I'm pretty sure the warehouses have been increasing, especially in New York for Brinks, I believe.
Right. And if I told you that one of the mechanisms, in 1994, when Fibro squoze, for lack of a better word, the market, they started taking delivery of silver out of the warehouse. Now, how much they were physically taking out, how much they were just throwing a sheet over, I don't know. But that caused the market to rally. Now, if you're a bank, this is hypothetical, but it's informed. If you're a bank and you've just gotten killed on the short side after Brexit in 2016, one of the ways to discourage that again is to put as much silver into the warehouse as you can. And I'm pretty sure that's one of the ways that silver has been kept in its place, so to speak. So my answer is, one, what would make silver rally again? Too many shorts. That's obvious. And the catalyst. I don't know what the catalyst is. Also, what does too many shorts mean these days? It could be a lot more considering the platinum palladium like lunacy. Two, technology. Technology killed silver with film. Technology will rescue silver. It'll be in the form of the technology that allows them to use thinner and smaller amounts of silver will create more retail products, like, for example, using a thin layer of silver in a windshield as a defroster instead of copper. That type of thing. As the technology becomes more efficient with use of silver, you'll see silver being more demand at a retail level. Solar panels. The low price of oil in a long term is horrible for silver. Solar panels are a big user of silver. And I talk to a scrap dealer a lot, and he's starting to get solar panels given back to him now. And that's technology. But the point is technology. Some application is going to cause silver to do its own thing. And the third thing is and this is an outlier, but I really think that it's something to be careful of. Although I do not think, I have tinfoil hats. I'm not wearing one now. Although I do not think that the United States would ever confiscate gold again. They don't have to. You can confiscate gold wealth by making it, if it's not in the bank, it's no good, or if it's, you can put a tax on it. Exchanges can. The CME, the COMEX, is not, it's in the rules. The COMEX can suspend delivery. It can make the contract go to cash. What I'm getting at here is that you won't see confiscation of gold in the U.S. You won't see that. You can see other things to dissuade. We're better salesmen than we used to be. But in China, okay, and this is why silver rallies. Okay, this is the other outlier that just makes silver, I think. This is why J.P. Morgan has won a lot of silver, I think, long term. If China were to, they don't have to be as sexy as the U.S. They're not a democracy. If China were to say ownership of gold is no longer illegal, it's all ours. One of their military leaders said years ago, we hold our gold wealth in our citizens. And it came across as a patriotic statement, but it really is a license to say, and we can take it anytime we want. And I'm very familiar with China's market structure. The point is, if a country heavy-handedly restricts the ownership of gold, you're going to see silver rally because you can't restrict ownership of silver. It's not money, but it's a core product for any industry. And so I think silver becomes more precious if less people are permitted to own gold or something like that. I hope that kind of helps.
Yeah, no, that definitely helps. The fact that we're talking about gold and the future of potential situations with gold bullion. The Federal Reserve, there's been a lot of people out there. I think a few years ago, PIMCO published an article about, the Federal Reserve needs inflation. They need price inflation, and they want it badly because of the amount of nominal debt they have out there and the future liabilities that have been promised. I think they really want to devalue the U.S. dollar long term.
Absolutely.
And so there's been people who speculated about, at some point, the Federal Reserve, they're not going to confiscate gold, but they may actually open a public bid for physical gold from citizens. I think PIMCO had published something like a $5,000 price for gold. And what do you think of the potentiality of something like that occurring? Would it have to come out of like a severe crisis, or would it just be simply the Federal Reserve, doing their best to try and push price inflation further?
That's interesting. I'll look at that article. I haven't seen that article, but I do have something to add to that, and it's based on what we were discussing earlier. If you believe, as I do, that China, Russia, the Swiss National Bank recently, and the ECB recently have become big buyers, more aggressive buyers of gold for banking regulation reasons, and you believe, as I do, that a big part of this is in Europe, and we're going to get to the U.S. here because this is where this ends up. Europe has become more important to not be short gold or to be long gold because you're issuing so many more negative interest rate policy rated bonds. So if you are buying, and I might be giving us the future for the U.S. This is your two main points about devaluing the dollar and how to get some gold just in case that happens. If I'm a country, in this case the EU, the European Union, and I am printing money, quantitative ease, printing money or lowering interest rates, and then taking that money and buying my own bonds. That's quantitative easing, sanitizing the monetary printing. What I'm really doing is, as we did in the U.S., just increasing my balance sheet. I own my own debt. I'm buying, and I'm trying to get the economy to go. And in the United States, it has been successful by many measures. But in Europe, they have bought their own bonds to negative interest rates, and they're still not out of the problem. Now, when you have printed that many euros and you have bought that many bonds, your own balance sheet as a central bank is at risk. What if the euro collapses? So they have to buy gold. Now, to the U.S., I don't believe the U.S. has started buying gold yet. I believe, and I feel pretty strongly about this, that being the monetary reserve currency of the world, not only do people conduct most of their trade in the dollar, but every bank, every central bank has to have a lot of dollars on reserve. That has artificially, if you want to call it, supported the dollar. I believe that in the race to the bottom, that is currency debasement, competitive debasement, U.S. ultimately has to devalue its dollar, as you say, to make its debt worth less abroad. And that is going to happen. It would be nice to have everyone else long dollars first. And so, and I say this, it's kind of like a bag holding situation. I'm a small Latin American country, and I have pegged my currency, the Vint peso, to the dollar. Okay, the dollar keeps getting stronger. That causes inflation for me. I need more dollars. So I do trade with, let's say, China. I sell them my soybeans. They give me dollars. And when all those emerging markets and smaller countries are long dollars, and the U.S. has printed all they can to counteract whoever else is de-dollarizing like China, then the dollar will be the last currency to circle the drain. When that happens, or before that happens, or concurrently, I'm not sure, then I think the U.S. becomes a gold buyer. Maybe the way that you described it, which would be crazy to see, but that the dollar will be debased, just not until they've printed enough and put them in everyone's hands. That's the end game. How long we can go on? I mean, I don't know, but that's what's going on right now. That's exactly what's going on. So,
just to put a cap on that one, no, I mean, Vince, you've been in this game for decades now, and you've been watching it like a hawk. What, if anything, at the moment, any additional points might precious metal interested crowd be missing or not factoring in currently enough?
Okay, here's a little insight I think that's going to help people when they scratch their head looking at, say, gold and silver, as their own commodities but on the same screen. In the past, when there was a precious metals recommendation to buy, when the bank said, we recommend you put 5% of your portfolio in precious metals, and the Goldman Sachs clients, all that, they started buying. Silver overperformed higher and it overperformed lower. But a bull market in those days for precious metals was led by silver. And here's what I mean. If silver and gold moved at the same time or silver led, you had a bull market in precious metals. But it's when gold, and this is pre this year, but it's still relevant. But when gold led, and then a couple days later, silver rallied late, that was almost always the end of the rally. Silver at the time was, as people call it, the poor man's gold. I think that's a bad saying. But if you're a hedge fund and you've already, all the big hedge funds have put their billions of dollars in gold, let's say, the smaller hedge funds would say, well, gold's really rallied relative to silver, and we really don't have that much money to allocate. We'll just buy silver. And then silver will just have this 2% spike, and you have no idea what's going on. Gold doesn't do anything. That's the top of the market. 9 times out of 10, that would be the top of the market. That information I just shared with you comes straight from a former GSCI guy, the guy who ran the index. When silver rallies last, be careful. That's the end of the market, unless there's a fundamental thing going on. The other thing, and the reason it's still valuable going into today is now all these people that had been buying silver because gold was rallying and getting stopped out, you've scared away or you've demoralized short-term silver traders. Meanwhile, short-term silver traders are trading gold now, and that's going to work in both directions. And now is accumulation time. I would love to see gold drop 2% and silver drop 4%. Would love to see that because that's what's going on. But the final point I want to make that I think is actually very relevant, the inverse of what I described before with the GSCI is happening now. Here's what I mean. If I'm a bank or I'm a customer of a bank and I want to buy gold at a lower price, and gold is stubborn for whatever reason, there are central banks in there that won't let it go away, momentum funds that keep making it rally, you're starting to see now when all else fails, and let's face it, there aren't many thinly traded hours where markets are spoofed anymore, especially with the cases that are going on. What you do is you sell silver. Silver used to be the last to rally when it wasn't a true bull market. Now silver's the first to drop because it is a true bull market, meaning I need to buy gold. Gold is 5,000 up. I can't get that to move. Silver's 1,000 up. The buyers no longer care. I'll sell silver. Silver drops, gold drops a little bit, and then when by the early part of the day, you'll see silver drop and gold drop along with it, and then you'll see silver stay down and gold rally. And so what I'm saying is, if you see silver get hammered and gold drop as well, silver may not be a buy. Gold may be, but they're going to start using silver now to keep gold in its place. That's my long-winded version.
Oh, yeah. Well, thank you so much for taking the time out today, Vince. I wanted to give you a chance to let the listeners know where they could potentially find you online, where, if they're interested in hearing your thoughts real-time on markets, where could they get you? Normally,
I would put out information on Twitter at the Lanci Pictures. Don't ask me why it says pictures. The LANCI Pictures on Twitter. And recently I haven't been so regular because I just started trading again because of the way the markets are, and I'm just running some family money, and I've been setting that up. But I do encourage you, if for no other reason, add me to a list. Following is not that important as long as you can see what I'm doing. But I recently partnered with a gentleman named Michael Moore, and I'm not a technician. My trading system is based on volatility. And Michael Moore is a technician he's best of breed, and he does energy and he does gold. And I'll put up excerpts of his report, which are $2,500 a month. And he's in the process of creating a more retail product at my request. At some point, that's going to be released, and it might be worth your while. In the meantime, I would say, tune in and look for any levels that I give, because his stuff is really good. And if you see me on Twitter talking about something called VBS, that's my system. And you can follow me so I can DM you and give you private answers. I also guest lecture at UConn, and on occasion, I used to do the Gold Fix, which will start up again. But the best way to get me is through Twitter. And if I'm not pulling my hair out, why didn't buy gold yesterday? I'll answer you in a timely fashion. I hope that helps.
Yeah, it does, Vince. Thanks so much for coming on the podcast, and hopefully we can bring you back sooner than later.
Oh, I would love to do that, and I want to make a comment. 5 years ago, I was writing. Well, actually, in 2016, when I was writing about silver, I had contacted someone. I think it was at a friend of mine's place, and I said, I like the SilverDoctors site. I think I want to post on there. And the comment was, be careful. Those guys are piranhas. If you don't know what you're talking about, they will chew you up and spit you out. And so I'm happy to be talking to a community that is more than just a bunch of FOMO guys. Silver is something to buy and hold. It's not just something to chase. So I love your community. I appreciate it.
Well, thank you, Vince. Thanks for coming on our podcast this week.
Thanks for having me, James.